Today I have the 7 best day trading strategies for you that work for Forex, cryptos, stocks, futures, commodities and all other markets. We're going to take a look at multi-time frame trading. I will show you how to trade the best price action patterns as a day trader, how to trade trend following and also trend continuation trading. And we're going to take a look at the 1 minute until the 5 minute time frames. We're starting with a very simple but very effective multi-time frame strategy where we're going to take a look at fake out trading. Some traders may refer to this as trap trading, and others will call this liquidity spikes. We're starting on a higher time frame. This is the daily time frame, and here we want to take a look at the overall trend structure and to find our trade signals. So what we see here is that on the left side the market was in a constant downtrend. The downtrend then bottomed out, which means that the market was not able to advance the trade further. So what we do here is mark the lowest trend point here, and we use this as a reference point going forward. We want to see what the market is doing when it's reaching the level here the next time. This is exactly what we want to see. The market moves into the level and gives us this fake out signal. Some traders may call this a liquidity trap. What happens is that the market pushes through the level, which makes it look like a potential breakout. However, within the same candle, the market shoots up and closes as a pin bar. This is a clear sign that the market is not able to advance to the downside, and this could give us a bullish bias, which means that we can now go to the lower time frame for our day trading entries and look for bullish moves away from this pattern, because this shows us that there's a potentially higher likelihood of the market going higher, moving away from this rejection signal. When we go to the 5 minute, what we see here is that we have a potential inverse head and shoulder. We have the left shoulder on the left side. This is our double bottom, the head, and then we are currently here at our right shoulder. What is really interesting is how the market is pushing into this blue level, which we can use as our neckline, and also what we can come in really handy for our trading plan. We don't want to buy below a resistance level, so we have to wait for the market to get above this. But how the market is moving into the level is already very interesting. We're seeing a lot of momentum pushing into the level, and you can see the market is not able to pull away. This is a very clear bullish sign. Shortly after, we see a failed attempt to reverse to the downside, and then we snap back, and with a lot of momentum we break the highs. This is overall a great signal because it shows us that there was an attempt from the bearish side to reverse the market lower from the resistance level, but there was not a lot of selling, and the moment the price dipped, the buyers came in. They were waiting for a lower price and then snatched up the market, and then you can see the strong momentum that led us into the breakout. Overall, a super bearish signal. And at that point, this is where the breakout traders will get in. When it comes to placing your trade, typically what you will do is you have your stop loss somewhere underneath the breakout level. You could, for example, put it all the way below the last swing point. If you are a little bit more of an aggressive trader, you could choose to move your stop loss closer to the breakout area. However, the closer your stop loss to your entry, the higher the likelihood that it will get taken out. So if you want to increase your win rate, this is potentially a way to do by using just a little bit of a wider stop loss. For a target, what we do is we look left. We want to take a look at the market structures. Here is the highest point that we can observe in the screenshot, very important swing point that led to this downward trend. So we ideally want to be out before the market hits such an important resistance area. And this could give us a 5.29 reward to risk ratio, which is exceptionally large. Then you can see it was not an easy ride and the market moved up and down. Here we hit a resistance, and when we look left, this could have also been used as your first target potentially. Or for traders who don't want to hold their trades for too long, you could have taken this as a complete exit, the first major resistance level, because you can see afterwards the market hit this resistance, moved lower, and then ultimately made it to the second target, but it took a long time. And this is a very important level. The further away your target, the harder it will be for the price to hit it. Also, your holding time will be exponentially larger the further away your target is. So if you want to experiment with holding time, choose a closer target, and that might be easier for you to endure. Before we continue with the video, I want to show you my new trading program. I call it the Tracademy. And this is the ultimate all-in-one trading education program. What you will find here is a completely new trading course. I've recorded over 80 videos with brand new trading content. The videos in this trading course have never been shared anywhere else before, and I go way deeper than in all of my YouTube videos. Also, you get mentored directly by me. I'm not using other teachers, I'm not using other coaches. I'm the one that you're always interacting with. There are live webinars taking place almost every week, And there's also a private community with other traders from all around the world, and also me. I'm interacting with all of my traders in the Tracademy directly and personally. So you join the new video course, you get personally mentored by me, you have new trading strategies. They are completely brand new strategies. I've never shared the videos before. They are for swing trading, day trading, and for all the time frames. There's a great and supportive community. It works for Forex, commodities, cryptos, and also indices. Everything that I've learned mentoring traders for the last 8 years and having been trading myself for over 15 years is included in this course. There's also a certification program. So after you've gone through the course and you have learned the material, there are 60 trading questions waiting for you where you can prove your knowledge and then at the end get certified. So if you're interested, make sure to check the video link in the description below. If you have any questions, leave a comment. And if you decide to enroll, I look forward to welcome you in the Tracademy. Next is a daily high-low trend following strategy. And I've talked about this briefly before, but I want to show it because it's such an important day trading strategy. And what we're doing is we can stay right away on a 15-minute time frame. And what we're using is the daily high-low indicator. I made a video about this recently on my YouTube channel, so you can check that out. And what we have is that this green channel represents the high of yesterday's price action. So you can see this green line corresponds to this high, this green line corresponds to this high. So we always get the price action of the high of yesterday, and of course the same applies to the downside. The red channel shows you the low of yesterday's price action. And what you can see is that in an uptrend, this is typically what the channel or how the price behavior around the channel looks like. In an uptrend, the market typically pushes into the highs and fails to reach the lows. This is then how trends evolve and how trends manifest. So when you see that your market is showing you such a pattern, it shows you that overall you're in an uptrend. What you don't want to see is the market pushing into the daily lows for an extended period of time if you're looking for longs. But you can clearly see in this example, the market is in an uptrend. We are pushing into the daily highs. The market is moving lower, not coming close to the daily low. And therefore, we want to look for bullish continuation trades. A bullish continuation trade signal could be given when the market pushes into the daily high, such as here. We push into the daily high. We see a small reaction. The smaller the reaction that we see at the daily high, the better it is, because it shows us that a lot of traders are interested in selling here. Typically, many day trading strategies use the daily high or the daily low for target placement. And if you have in an uptrend a strong reaction at a daily high, it could indicate that there are a lot of traders selling and getting out of their bullish positions. And also that there are not a lot of new fresh buyers. But if the reaction is minimal, that's a great signal because it can show you that there is not a lot of selling interest and there's still a lot of buying interest. And you can see the market shoots higher. We get a huge momentum candle. This could have been used as an entry signal. Stop loss underneath the daily high, typically that's what you do. And then, for example, you could shoot for a 3-to-1 reward to risk ratio. And the market quickly advances higher and pushes into the 3-to-1 target. In a trend following environment, you could potentially also think about having a wider target or riding your trades with a trailing stop loss approach. That's a little bit up to you. And that is just one idea of how to approach this. The daily open momentum strategy uses the concept of sessions, and especially in Forex and in stock trading, this is very important because the theory says that when a new session opens, for example, when the UK session or the New York session opens, typically you should see a stronger than usual momentum and volatility level because that's when the traders get to their desk, that's when the trading officially starts, and that's when you see the most amount of orders being placed and the most amount of trading activity. So what we see here is that we are on the 1 minute time frame. The market has been moving higher in this yellow zone, which is the Asian session. And you in TradingView, you can find a lot of free indicators for the sessions. You can just search for session time or Forex sessions or trading sessions. You should find a few options. What you see is that we are overall in a bullish trend. Then after the Asian session, the market topped out, which makes sense because probably fewer traders are left. Many have already left the office and the trading activity is just lighter. What we then do is we wait for the UK session to open. And what we want to do is try to look for trend continuations. We want to see if the market can continue the previous trend that was started in the Asian session. In this example, it's very clear. We have this very straightforward horizontal resistance level. And what we want to see is that close to the open of the UK session, we want to see if the market can show us a strong breakout here, which in this case happened. You can see we are still very early on in the UK session. This is the 1 minute time frame, so we are very early on in the UK session. And you can also see we are seeing strong momentum. That's exactly what you want to see. You don't want to see the market just crawl over the level. You want to see a decisive active push through a resistance level. Target-wise, very straightforward. We can zoom out and look at the last supply area, which in this case is very obviously here. And a target could be placed here underneath the last resistance area. And you could end up with a 3-to-1 reward-to-risk ratio potentially. The great thing about such a trading approach is that you will quickly find out if your trade idea is working. You're on the 1 minute time frame, you're early on in the UK session. And if this works out, typically you will see a quick follow through on your trade when the momentum and when the trend is continued from the Asian session and when the traders are agreeing. So that is a great trading style for traders who don't have as much time. You typically just have to monitor the price action for the first few hours of the UK session or for any session that you decide to trade. Next, we are using engulfing candles and a trend following pullback strategy. What we see here is we are on a daily time frame. I'm using the 13 period EMA, and this indicator shows us the trend direction. And in this case, you can see the market is trading below the EMA, which tells us we are in a short market. And then we are seeing a pullback. The pullback reaches into the EMA. Ideally, you don't want to see that the market is able to break the EMA. If it would break the EMA, it would not make it look good for a pullback. But in this case, we see clear rejections. And then here, the last candle is a engulfing candle. The engulfing candle is a very strong bearish signal. And this is enough for us to go to a lower time frame and look for trading plans. Of course, we want to short because we are in a downtrend. And that's why we are looking for those bearish continuation signals. On the 5 minute time frame, we see here the downtrending move, and then the market is currently stuck in this range. Again, we don't trade in ranges. We want to make sure that the market is clearing ranges. Still, we are in a range, so we had to wait quite a bit, but the market is still in the range. What happened here is quite interesting. We have a fake out. The market tried to break the resistance level, but was rejected. There was not a lot of momentum, and we are back inside the range. This is overall a very good addition to our overall trade scenario. This is a great bearish signal because it shows us that not a lot of bullish interest was here in this market. What we do now is we just simply wait for the market to clear the resistance. Not sure if you can see it, but the market broke the support level here with a strong breakout candle. When we zoom out, our target could have been placed just a little bit above the previous swing high, and our stop loss could be somewhere back within the range. Depends again on your level of aggressiveness. Do you put it all the way back above the range? Do you use or put it closer to the low end of the range? And you can play around with this in your backtest. And then you can see once the market is clearing the range here, we see a very good push into the previous support level, where we could have also placed our target. And this is again highlighting the importance of not trading inside of ranges. You want to make sure the market is clearing the range. Not being stuck in a range is very important for your price analyses. Within a range, the price action is very unpredictable. Usually you also have more volatility. You want to make sure the market to really pick a direction, show you a momentum breakout, and ideally that's where you want to trade.